No, that's it. An operating lease for a lessor. So if Harris had been doing it as a lessor, that's easy enough. He would just debit cash, credit income. So I give him $16 million, you show $16 million of revenue, you get $16 million of cash. That's easy. So there's not really a lot to do with that. We've done the demonstration, sales and leasebacks. Now, a sale and leaseback, I'm going to borrow someone else for this because I've been using Harrison, who's leasing from him for too long. A sale and leaseback is obviously a leasing situation, but it is almost, if you will, a reverse mortgage. You're actually getting finance on an existing asset that you have. Various companies have done it, state governments have done it. Arizona state government in the US did this a few years ago. I'm pretty sure the New South Wales government have been involved in these sort of things as well. That's not to say they're not a bad thing. They're fine as long as they get accounted for properly. So the idea between a sale and leaseback transaction is you have something. So I'm going to borrow you for a second. What's your name? Jason. So I have, let's just for argument's sake, I own this building. So I own it, but I am cash poor. And you could argue with the amount of money UTS is spending on various properties at the moment that they may well be cash poor, but I don't have a lot of free cash. So what I'm going to do to alleviate that situation is I'm going to sell this building to Jason, and then immediately I'm going to lease it back. And so that's all just that's not a made-up transaction, but it's not like the building moves, I give it to you, then we put it back and we keep using it. The building just keeps getting used in the same way if it's a finance lease. If it's an operating lease, it may be slightly different. So the thing that we're worried about though is, has a sale occurred? So this may be sort of casting things back, but imagine, just for use of analogy, that this clicker is the physical property that is this property. How do we know for a sale of good when I've actually sold it to Jason? How do we know when we sell something, when you get to book the sale? Yeah, has control been passed to the other party? The risks and rewards of ownership, have they been transferred? So that's what we're looking at with the sale. Have you transferred those risks and rewards of ownership? So that's fine. So I sell him my clicker. He's got the risks and the rewards. Hey, can you click the right button, like the go forward button? Thank you. Okay. If it's a finance lease back, we know with a finance lease that the person, so he's leased it back to me. With a finance lease, let me just borrow it back now, the risks and the rewards come back to the lessee. So if I've sold it, given you the risks and rewards, and then leased it back and got the risks and rewards back, did I ever actually sell anything? It's kind of like one of those philosophical, if a tree falls in the woods, and no one hears it, did anything happen? If a sale has occurred and then it's leased back as a finance lease straight away, did a sale ever really happen? And the way the standard is set up is pretty much, they go, well, no, not really. Because if that was the case, and I'm going to, that's bugger. Screen set up. So imagine this. Imagine I had an asset on my books for $100 million. I then sell that asset to Jason, and I sell it to him at fair value, so everything's above board. And I sell it to him for $120 million. Then I lease it back as a finance lease. So in this transaction, I've got a gain of $20 million. That's all well and good. And if we ended at that point and didn't have any of that happening, that's where the story ends. But I've leased it back as a finance lease, and we're just going to assume that we've leased it back fair value and the present value of the minimum lease payments are going to be the same number. I would then have an asset on my books of $120 million. So if there wasn't specific provisions in the standard, pretty much every company could do this. They'd just set up with someone else and go, look, I'm selling you this asset. It is legitimately under its that fair value is legitimate. It's at cost on my books. The fair value is higher. We're not trying to just make up fair values here. I just go to a third party, go, will you buy this asset and I will lease it back from you. I get to book a gain. I get to increase the value of the asset on my books and I've still got the asset sitting there. So I am $20 million up in terms of my assets on my balance sheet. I'm $20 million up in terms of profit in that year. Happy days. Now, obviously, that isn't what happens. What we look at is, now think of the analogy towards, if we were using the revaluation method, we can actually do this. We can actually go from 100 to 120 and show a $20 million increase in the asset. But we'd be crediting not reserve. We'd be crediting revaluation surplus. We wouldn't have a profit impact. So we don't have a problem with the fact that the asset's gone up in value because you could do that realistically anyway. The issue is more around the profit. So what the standard allows you in 59 is saying, okay, that $20 million, and we're going to say we're going to lease it for 10 years. That $20 million, you get to show $2 million of profit. Sorry. You get to show $2 million of profit a year. So it kind of gets housed in other comprehensive income and then drip feeds back in slowly. But then you may say, well, hang on. In year one, we've got $2 million of profit and then another two, then another two, and then another two, and so on, all the way to the 10th year. If we revalued this, we never had that profit impact. So why is that allowed here? And it doesn't perfectly work out. I've just been thinking to myself. But you still actually, on one hand, there's something you sort of take away from this, which is the depreciation expense. You're now depreciating a $120 million asset over 10 years, not a $100 million asset over 10 years. So the depreciation, the marginal depreciation has gone up by 2. So you're actually not showing any net profit impacts from this over time. You know, there are some other bits and pieces. Well, I mean, there's one small thing to consider with that, but it's useful to maybe play around with that at home. But the idea is they just wanted to stop people making those one-off profits, because otherwise everyone could just sell assets to somebody else. They could book the asset going up and they could book the profit in that 1 year, even though no sale had actually happened. So just something to think about.